Hello, thanks for tuning in. This is Rich Lowry of Park Edge Advisors with our fourth quarter update, which I call Sleepwalking into Recession. Um, Let me start with an unofficial sentiment check. I say unofficial because it's not based on any hard data, but this is a sense I get as I talk to clients across the firm. We tend to fall in one of three buckets. The first, which I think the majority fall, is stay the course, patience is going to be rewarded. That's in blue. There is a segment that is buying into the media narrative that says that this is going to be a soft landing. And if this is going to be a soft landing and we avoid a recession, that means last year must have been the recession. Last year must have been the bear market. And the bounce to start the year is an indication that a recovery is underway and we may be missing something. I plan to walk through why we disagree with that point of view. And then there's another segment that says it's been so long since any of us can remember getting 5% risk-free in T-bills. Why don't we just park money there and call it a day? I agree with some of that in that 5% risk-free in T-bills, I do think is the most attractive asset out there for the time being. Where I disagree with that approach is at some point, the recession is going to arrive. It's going to force the Fed to cut. The 5% is going to become 4, then 3, then 2. And meanwhile, inflation is likely to remain sticky at 3 to 4%, which means if you earning 2 and inflation is 3 or more, you have a melting ice cube. And by the time that causes enough pain to want to change that strategy, the opportunity that we think lies ahead in the stock market is likely to come and go. So let's focus on the first part. Is the bounce that we had beginning of the year invalidating the recession? And is it saying soft landing instead? If we rewind to the beginning of the year, we said that there's room for the market to bounce. And that was based on the notion that every time you hit the lag between phase one and phase two of the recession, the market almost always bounces and it's almost always called a soft landing. So keep in mind, in phase one, things tighten. In phase two, things break. But there's a lag. Things have to tighten and remain tight. And the longer they remain tight, the more likely things are to break. Historically, when you hit that lag between phase one and phase two, the average market bounce is 11%. We saw that coming, and that didn't seem like the right risk return trade off, given that in phase two, we could see 20, 30, 40% downside. The other factor we called out at the beginning of the year is that there were dynamics unique to the debt ceiling that caused liquidity to flip positive for a few months. First of all, the Treasury was sidelined from issuing any new debt. And when they issue debt, they push bonds into the economy. They take liquidity or bank reserves out of the economy. That lever was sidelined because we were up against a debt ceiling. And commensurate with that, the Treasury spent down their bank account. And when the Treasury spends down their bank account, that pushes reserves into the system. And that was enough to more than offset the tightening that the Fed was doing. So, notwithstanding the fact that the market usually bounces between phase one and phase two, and notwithstanding the positive liquidity dynamics for the months leading into the debt ceiling, it really hasn't been a broad-based bounce. If you subtract the 7 stocks most closely connected with artificial intelligence, the so-called AI7, the S&P is negative year to date. So it doesn't really have the markings of the kind of bounce that you would expect to see coming out of a recession or a bear market. We think that's going to be a 2024 event. If we look at the data, this is a index of coincident measures of the economy. And you had 2 soft landings, one in 2012 and one in 2015. In a soft landing, you have above trend growth here that declines, stabilizes, doesn't go negative, and that's a soft landing. In 2015, you had growth decline below trend, stabilized, didn't go negative, that's a soft landing. If you look at where we are today, and assuming that's all you looked at, you could say that this looks like a soft landing. The trouble is this is a coincident index. It doesn't tell you what's likely to happen around the corner. To do that, you have to factor in leading indicators. So going back to the 2012 soft landing, leading indicators did decline. They never went negative. So all along, they confirmed soft landing, and we're not even saying hard landing. In 2015, leading indicators peaked and declined. They momentarily went negative, but bounced right back. Leading indicators were confirming soft landing, and we're never saying hard landing. And if you look at where we are now, leading indicators are deeply negative, which is indicative of a hard landing. In fact, when you have a negative spread between coincident indicators and leading indicators, this deeply negative, in every case in the past, that has coincided with a hard landing. You could look at several measures and they all draw the same conclusion. So in the 2012 and 2015 soft landings, none of these measures here indicated that we were headed for a hard landing. All of those measures indicated that that was going to be a soft landing. In the financial crisis in 2008, every single one said hard landing before the recession hit. In the tech bubble, all but two said recession before the recession hit. And in the current cycle, all but two are saying recession, which leads us to conclude that it's not going to be a soft landing, that it's going to be a hard landing. The only thing saying soft landing are newspaper headlines, but that's nothing different. In fact, every time you hit the lag between phase one and phase two, it almost always gets dubbed a soft landing. And this time is no exception. So back here, you had none other than Ben Bernanke in 2007 saying that we're headed for a soft landing, and we know what happened after that. In 2000, we had newspaper headlines saying soft landing. We know how that turned out. So it's not the newspaper headlines that's going to determine hard landing or soft landing. It's not a market bounce, particularly a narrow market bounce, that's going to determine soft landing or not. It's basically going to be the cycle. So to track the cycle, a handy acronym that a colleague at Piper Sandler developed is called HOPE, H-O-P-E. H stands for housing, O stands for orders, P stands for production, E stands for employment. It represents the mechanical sequence of every past cycle. Housing is always the first to turn. It was the first to turn this time. It's negative. It's not rebounding. Orders are usually the second to go. They were second to go this time. They're negative and not rebounding. Production is the third to go. It was third to go this time. It's negative and not rebounding. And employment is the remaining part of the sequence that has yet to flip. But once that does, that will mark the commencement of the recession. If you had to draw it up in a textbook, it would look something like this. The aggregate economy here is what actually determines recession, which is marked by the red star. But that is coincident of what's happening today. What's more important are the measures that lead that tell you what's likely to happen next. So to give you an analogy, this could be new home sales. Not me selling my house or you selling yours, but a newly constructed home. And if you back up from that, residential construction would be a leading indicator that you would see here, and building permits would be a leading indicator that you would see there. That sequence is mechanical. It can't be shuffled around. You have to get a permit first, then and only then can you build, then and only then can you sell a house. As it relates to the manufacturing side of the economy, this would be new orders. The company gets an order, goes into backlog, they pull something out of the backlog, put it into current production, and production would show up on the second cycle. The finished good goes into inventory and then it's sold, and when it's sold, that would show up in the coincident cycle. So respecting the fact that there is a mechanical sequence is just a matter of following where we are in each one of those components. As I mentioned before, housing is already negative, orders are negative, production's negative, employment is the last thing to go. So here we broke out leading employment from coincident employment. Coincident employment is in blue, and when it goes negative, the recession's going to be here. In order to tell when that's likely to happen or whether we're on track for that to happen, we'll follow the leading employment index in red. The longer the leading employment index in red stays negative, the more likely that blue line is going to be negative or become negative. This is a slide from a couple of weeks back. This is last Friday's employment report And you can see it tick down again, and it's now just 1/10 of 1%. Sorry about that. 1/10 of 1% above going negative. Another way of looking at leading versus coincident employment is to measure each against a composite of the last 5 recessions. So over here, we have leading employment against a composite of the last 5 recessions. And to me, that looks like it's following the typical script. I don't see any unusual behavior there. This just has to play out. In coincident employment over here, same thing. It looks like it's following the typical path of the last 5 recessions. I don't see anything unusual there. A leading indicator of leading employment are continued claims for uninsurance. And in the last couple of reports, we ticked up to the recession threshold, we flatlined, ticked above it again. And in the report that came out this morning, it ticked up a little bit more. The longer this stays above the recession threshold, the more likely that leading employment is going to remain negative. If we back up to June of last year, June of 2022, which is here, we said recession is on track at year end into the first quarter of 2023. And as the year progressed, it was a steady decline. But rather than hitting the first quarter of the year, which is right about here, and going into recession, you see that we flatlined. The flatlining has us hanging in by a thread. So what we want to do next is drill down and find out what is behind this flatlining, because when that turns, that's likely to coincide with the recession. When we do that, one tool that we can use to measure the lag is when the yield curve inverts. Yield curve inversion means that short-term rates, namely the 3-month Treasury bill, has a yield that exceeds the 10-year Treasury. The normal behavior, the normal slope, is the longer you tie your money up, the higher yield you expect. The unusual behavior is when short rates exceed long rates, and that's done in phase 1, when the Fed jacks up interest rates so much that short rates are now higher than long rate. From the point of inversion, you simply count how many months until we're in recession. This measure has a perfect batting average of preceding a recession. The real issue is what's the lag from the time of inversion to the time that the recession hits. So in other words, what's the lag between phase 1 and phase 2? On average, it's 12 months, and currently we're right at 12 months. So this, by this measure, it's saying it could be here any month. Another way to look at it is from the peak of the leading indicators. And from the time the leading indicators peak, you count how many months until you hit recession. On average, it's 16 months. Currently, we're going on 23 months. So there's something different about this element that is extending the cycle. And if we drill down to try to isolate what's behind it, we see that residential construction has flatlined, is barely hanging in by a thread. Going back to the prior slide, this is attributable to the overall economy hanging in by a thread. If this were following the path of the typical recession, the blue line would be following the black line. So what we want to know at this point is what are the leading indicators for this blue line, which are going to likely tell us whether the blue line will continue extending or whether it will begin catching down to where the black line is. The culprit seems to be that residential construction is taking longer to complete. So whether this is the leftover remains of supply chain disruption or any other reason for that matter, on average, it typically takes 10 or 11 months. It's now taking 16 months. The fact that projects are taking longer to complete means workforces are remaining employed longer. And the reason that residential construction is important is not only is a house going to be sold or an apartment going to be finished, but that usually coincides with a new microwave and dishwasher, furniture, et cetera. There are spillover effects associated with this. So what we want to know is there enough coming in the pipeline that as these projects, which are taking longer to complete, are finished, there's going to be enough to keep the pipeline full, to keep workers employed. If not, we would expect the employment part of this cycle to turn. Units under construction have remained flat. So there's no longer been growth this year. That's a sign to us that as the units, which are taking longer to complete, are finally completed, there's not going to be enough coming in to fill up the pipeline. And a leading indicator for units under construction are permits. And you can see building permits have collapsed. And 16 months ago coincides with generally peak activity. Since then, permits have collapsed. And unless permits get turned around, you can't expect units under construction to begin growing. And if units under construction haven't been growing, then we would expect the layoff cycle to commence as these projects are complete. Now, as it relates to this bounce, it's a fair question to say, well, we're seeing some upward movement there. Is that likely to continue, or is that going to resume down? And a leading indicator for permits is the National Association of Home Builders Housing Market Index. This red line here is the same as the prior line, except this is using smooth data. But this bounce here is the same thing as this bounce. We're just using a moving average, and the NAHB index is pointing back down. So that's telling us that that red line is going to resume down and is unlikely to rebound. There are signs that phase two is emerging. So again, phase one is when things tighten. Phase two is when they break. There's a lag in between the two. One sign that phase two is beginning are bankruptcies. Bankruptcies are pointed straight up. It's not necessarily the level that matters. I don't want anyone to look at this and say, wow, it's as bad as it was in the financial crisis, because the composition is completely different. 2008, we had the biggest banks in the country and in the world, which have tentacles into every other business in the economy, so the risk was systemic. Here you have a different combination, or different composition rather. You do have some banks that have failed. Earlier in the year, you had Signature Bank, Silicon Valley Bank, First Republic. Before this is over, there are likely to be more. You have retailers that are going out of business. In the 2021 bubble, where you had SPACs and a bunch of speculative things come to market that really had no business being public. They went public because they could, not because they should. And you're seeing a lot of bankruptcies there. And you're seeing bankruptcies pick up in commercial real estate. But it's the direction of the line. You know, the behavior that we're seeing this year is not this kind of behavior. It's basically straight up behavior, and that indicates phase two. We're in the early innings of phase two. So in terms of what's next, it's really a matter of tracking the cycle. The cycle, there's the gravity of the cycle is going to determine the outcome. The media headlines aren't going to influence it. Whether the market bounces or not is not going to influence it. It's going to be the gravity of the economic cycle. We're in a position now, unlike last year, where inflation was 8 to 9%, and long-term treasuries were 3 to 4%. You had negative interest rates. So the nominal interest rate minus inflation is the real rate. So last year we had, let's say, 3 to 4% rates, inflation at 8 to 9. That's 500 basis points of negative real rates. Negative real rates are not restrictive. Now it's the opposite. Inflation is down to, say, 3% if you're looking at 10-year forward inflation. The treasury yields in that range and longer are 5%. So real rates are positive at this point. When real rates go from negative to positive, risk premiums expand. That's the same thing as saying we expect valuations to compress. Valuations are likely to compress regardless of earnings, which is going to mean stocks are down. When that happens, layoffs commence, and that feeds the cycle where layoffs are going to produce earnings contraction. As those people who are laid off cut back their spending, which means less income for the businesses that they're not spending at, et cetera. And that basically is the recession. We have some other catalysts. The big catalyst, the biggest catalyst of the year was July 31st, when the Treasury came out and outlined how much new debt they're going to have to sell. The bounce that we had at the beginning of the year ended to the day. Risk assets are down across the board. since July 31st. So it's been kind of a tale of two halves. The most recent update was bad, but it didn't get any worse, and the market took that as a bit of a relief rally. But what's going on is the Treasury has to sell an enormous amount of debt. So think of that as supply. And meanwhile, large price insensitive buyers are on the sidelines. Price insensitive buyers are ones that have to buy, not because they want to, because they have to. The Fed is not only not buying, they're selling. Global central banks are not buying, they're selling. Commercial banks are up to their eyeballs in underwater mortgages, and they're not buying. So when you take large buyers away from the equation, you're taking away a lot of potential demand, and that leaves us, households, to take up the slack. So if the supply demand equation is an immense increase in supply, at the same time demand is being reduced, that spells higher yields. And that's been playing out since July 31st. And it is likely, to continue. Other catalysts, student loan payments have restarted. They were suspended since the pandemic. And some reports indicate that 2/3 of above trend spending are attributable to student loan payments being suspended. We had the United Auto Workers strike, which is being resolved. The impact there is going to be twofold. The car companies overproduced cars last year in anticipation of a long strike, and it's likely that they end up having to underproduce cars going forward. And then the higher labor costs are going to be an item that keeps upward pressure on overall inflation. We're looking at another government shutdown, which is hard to quantify. Obviously, geopolitical risks have escalated. You have the disaster in Israel. At the same time, Russia and Ukraine are still going about it, and China is making its move on Taiwan. If you took the geopolitical component out somehow, assuming you could do that, to me, this is still a pretty bearish setup just based on where we are in the cycle. When you factor that back in, it means two things. You could get an unquantifiable negative impact if things escalate. But because we're positioned defensively against that, that's not likely to cause any kind of change. Or you could get some positive surprise. You could get some peace deal. You could get something that would get the market to bounce. If that happens, we would use any bounce to reduce risk even further, even look to participate on the shorter inverse side, because the more powerful component of this is going to be the cycle. And any bounce that you get out of any positive geopolitical surprise is not likely to last when it meets the recession. And then lastly, weak demand is the number one phrase on earnings calls. So if you plot this, we're on pace for a record number of mentions. This shows going back to 2008. The data series goes back to 2000, and we're on pace for a record. This is happening at a time when Wall Street is expecting a fairly significant increase in earnings for both 2024 and 2025. And it's hard to kind of reconcile the two. In terms of our positioning, this relates only to our all asset strategy, formerly named risk managed equities. And I'm showing this simply because it is the most flexible strategy. It can invest in any asset, stocks, bonds, currencies, commodities, cash. It could be long or short. So it is the most flexible, most unconstrained portfolio. So without any pre-existing constraints, this is how we have the money allocated at the moment. 70% is parked in T-bills. Most recent one we bought was 5.4%. We think that's the best game in town given risks that lie ahead for both the stock and the bond market. 21% in gold and US dollar index, which tend to be pretty reliable safe havens. None in bonds. And the reason we don't have any in bonds, as I mentioned, you have this huge supply that still has to be absorbed in the market. And we'd rather let that play out so that we can find at what price do bonds bottom and at what point do yields peak before we look to redeploy money in bonds. The best characterization of market behavior at the moment is what we call quad three. Quad three is growth slowing, inflation accelerating. And we get that by plotting rate of change of economic growth on the y-axis, rate of change of inflation on the x-axis. Quad three is risk off. Commodities tend to do okay in quad three, which is why we have a small position there. No equity exposure, and that's not likely to come until we're in the middle of the recession. Currently, we don't have any inverse funds. We previously had an inverse fund that went up when small cap stocks went down. We closed that and took a profit, so we're flat on the inverse position. But if we do get any year-end bounce, we would look to build that back up. And then the other category is an ETF that is doing its own version of an absolute return long-short strategy. If you have any questions about this, feel free to contact your financial advisor. And we look forward to the next update, which should be as we get closer to year end and kick off the new year.